poverty plagues every country on earth. It's announced it has eliminated extreme poverty. But that's not enough. The country aspires to bring everyone to common prosperity by the year 2050. How to achieve that? A journey on the road to common prosperity.
For people in economic industry, what we can contribute to common prosperity is to offer wealth management service for more people. In today's context, the wealth management industry contains the potential for lasting growth. Among its main drivers, rising household and corporate wealth, the funding gap of pension reserves, and the over-reliance on non-financial assets, personal responsibility for the aged, wealth transfer between generations. The pandemic has led to a sharp drop in income for many. On the other hand, highlighted the importance of financial resilience. Scaling up asset allocation has become an important issue in wealth management. What is asset allocation and how to determine the asset allocation for an investor? Let us have a look at asset allocation first.
Markets are like a roller coaster. They go up and down very swiftly, encountering sharp turns along the way. Equity markets were trading up and down during the last few years. Events like the internet boom, burst of the dot-com bubble, led by strong performance of the equity markets, followed by a significant sell-off during the 2008 financial crisis. A similar trend has been witnessed in the bond market, despite the fact that these securities are safer than equity. Bond prices are not only sensitive to a change in interest rates, but also sensitive to macroeconomic events and react just as sharply. Recent examples include the bankruptcy of banks like Lehman Brothers. So where to invest? An ancient proverb reads, "Don't put all your eggs into one basket," or "Don't allocate all your resources to one venture." This is a golden rule for all investors and represents the diversification of the portfolio to reduce risk. Using the above concepts for investment purposes is known as asset allocation. This describes distribution of investments into several assets. Investors have a large array of choices. Typical securities like equity, fixed income, real estate, hedge funds, or even commodities like precious metals, oil, or agricultural products. So where should you invest? That depends on a few factors that include your attitude towards risk, your age, and other personal circumstances.
Then let us have a look at how to determine the asset allocation for an investor.
Mix of assets an investor chooses depends on his risk profile. Some investors are very cautious and therefore risk averse. Others might be more aggressive, invest in very risky securities. Then there are those who take the middle road. There are three ways in which the assets are selected for asset allocation. The three types are strategic, tactical, and picking individual securities. Studies have shown that strategic asset allocation is key to keep the portfolio growing. It involves rebalancing the portfolio on a periodic basis. It contributes more than 90% to the overall performance of the portfolio. How to define a conservative, aggressive, or balanced investor? What makes them risk-averse or risk-lovers? The simple rule of thumb is to study the career path of the investor. If the investor is young and has a long way to go, he is likely to adopt an aggressive strategy and will take up more risky investments. Likewise, an individual who is looking to retire in a few years' time will not take unnecessary risks. Instead, he will look for safe assets to invest in, preferably bonds and dividend-paying stocks, so that he has a comfortable income stream when he retires.
So we need to collect and file customer as relevant information as much as possible, such as customer as name, gender, age, marital status. That is the foundation of customer-focused asset allocation. Next is to set your goal, such as the target pension at retirement or reserve for education. We also need to know your capital source and investment plan. Your attitude to risk is another crucial factor, which is R1 to R5 in China. By importing all this information, I plan to intelligentize customer asset allocation process by using actuarial models, which means I will automatically achieve asset allocation scheme customer and need, including the proportion of major asset, potential loss, product selection. What is more, I can monitor the goal after the implement of asset allocation scheme, such as the change of target achievement ratio, the projection of evolution process of asset size, especially when it moves in an undesired direction, and the comparison of yield or asset size under recommended asset allocation scheme and former asset allocation scheme. The intelligentized asset allocation process enables us to serve customer more accurately and efficiently, and help to spread the benefit of social development more fairly among the people, and to contribute to common prosperity.